Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry, and no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.
Another weekend, another weekly market recap. Welcome back. So, busy week again. If last week was all about labor market data, this week the focus shifted a little bit on inflation data with CPI and PPI, of course. But without wasting a lot of time, let's just jump right into it. We started with the United States non-farm payroll, the annual revision. And of course, I'm sure you already read the news. I don't need to waste a lot of time on it. But yeah, the economy actually created 911,000 fewer jobs over the last 12 months. Now, look, it's bad as a data itself, but it's not over yet because these revisions they come uh, in September, and then you're gonna have another final revision in February 2026. And the revisions done so far, I think they only cover up until April 2025. So we don't know a lot about, May, June, July, and August, and all the rest. So it could be that when we get into 2026, early 2026, these revisions will probably change one more time. But since we are here, let's just address the elephant in the room so we can actually give some sort of a closure to what was the last week focus. So let's have a look at these, for instance. This is basically an historical view of how these revisions usually work. Now, as you can see, they more often than not they're on the negative side, which again, it's just testimony that the BLS historically, it's not something recent. The data set here, it goes back in time for 10 years, basically. So as you can see, a lot of times the revisions are actually to the downside, which again, it's just a testimony that a lot of what you see coming out of the BLS in real time, right, week after week, month after month, it's more often than not overestimated. And then, of course, they have to revise the data when they can run different smooth processes or adjustments and all of the rest. But yeah, that's kind of the tendency here. It was one of the biggest revisions, if not the biggest revision on record over the last 10 years. And this is curious, right? The only one of the only times, or and at the very least the time where the revisions were not only to the upside but kind of substantial was in 2022 after the huge stimulus post pandemic. So no surprises there. But again, bear in mind that usually, I mean, it's not a statistical truth, but it's just again another tendency. What you tend to see in February compared to the revisions in September, the February revisions tend to be a bit more tame, right? So it could be that maybe at the end of the day, it won't be 911K. It could be slightly lower, or, at least, what we are about to see for the other months, which are now excluded so far from the revisions. So again, May, June, August, September, and whatever other month from here to year end, the revisions there could be a bit softer. So maybe we are not completely doomed so far. All right. Now, after that, here's another kind of a grim picture for the US labor market because it looks like uh, the only thing which is for now keeping the labor market alive is healthcare and education. So again, healthcare, I would say it's a sector where there is inelastic demand, right? Especially if you consider demographics, right? Because you always get more old people which will need assistance, or at least they are going to have health issues because yeah, they're getting older and older. So it's normal that the older you get, the more you need treatments, medicines, and all the rest, right? And the other component of the sector is education, which it's a bit strange, right? I mean, I think it was a mistake, which I'm looking at not only in the US but in my country as well. Uh, there was this push toward centralizing education, so to speak, or running the education department as a centralized level, and I think that's not the right path to go off to. So sometimes we have throughout the months we've seen while analyzing single NFP prints that many times we've seen that what made the numbers so good it was the amount of jobs added in the education department, which again it could be at a federal level or a state level, but it's just still it's just government employees, right? So I don't know how good these type of read would be. I mean, yeah, overall it's giving a contribution to keep the overall the average of the labor market afloat, but to me it's just a sign of weakness at the end of the day, right? Now, here another survey from the New York Fed, and these are basically expectations from consumers regarding the probability to find a new job or another job. And it's just plummeted, actually below pandemic levels, which is, quite tiring of a situation right here. So again, not only the data are now looking bad, but the sentiment it's shifting in that direction. It's always like that. I guess the good old saying goes like, up until the point someone is losing his job, it's basically nothing for you, right? When your friends or your family members start to lose their jobs, then you start to feel the recession. When you lose your job, then for you it's actually a depression. So again, I guess it's always the same type of things with sentiment and whatnot. But again, not a cool sign, right? Why it is important when you look at, should I say, why do we waste so much time looking at the labor market and all the rest? And we just don't only focus on the charts. Well, I mean, it's important to be aware of these dynamics because if you look at the 3 month average of employment, right, what you can see that basically it's on a slippery slope right now. And every single time in the past where it kind of tanked, obviously you've seen the economy going into a contraction, therefore a recession, right? Now, there are a lot of links that you can extrapolate out of the employment data alone, right? So, for instance, let's transition to this other one. When you look at the percentage of total employees, right, working full time, what you see is that it's kind of the same phenomenon, right? When you got a contraction in the labor data, oftentimes, if not every single time, should I say, standing to this chart, you get into a recession because you get an economic contraction. This is why, at the end of the day, uh, the full-time job, it's the one which pays the bills, right? It's the one which allow you to face all your obligations. It gives you the money to pay down your day-to-day, week-to-week, month-to-month expenses. It allows you to pay for your house if you have a mortgage. It allows you to send your kids to college and all the rest. So, and not discarding that the benefits that you get from full-time employee or full-time work, right? It's a hell of a lot different than what you get from a part-time type of a job. So again, no surprise is that this correlation sticks because it makes sense, right? So then if you expand the thing and you look at the relationship in full-time jobs, right? And the relationship with inflation and consumption, again, it's no big surprise there, right? The the fact that you have a full-time job, or many different people could have a full-time job, it creates much more confidence in the economy and in your financial future. Therefore, you're going to be more prone to consume, therefore contributing to inflation and in the end, economic output or economic activity and economic growth, right? So it's no surprise that full-time jobs are a driver for inflation and consumption. Okay. And then what you get from here is that if you, again, we have been looking at these composite index in the past, but if you look at wages, GDP, and inflation, they drive rates. So let's get back for a second. You got the labor market. Inside the labor market, you got full-time employment, which is driving GDP, inflation, and consumption, right? And therefore, all of these is driving rates because again, rates are just a reflection of the underlying economic situation. Okay, this is why it's worth its time to look at labor market data. Now, here's another thing. Labor market driving yields, and yields at the end of the day, as I've already stated in the past, yields are driving Fed funds, therefore monetary policy from the Fed. It's not the other way around, although the narrative that they try to sell you is that the Fed is so powerful that is impacting the yields, it's managing the yield curve and all the rest. Truth is, the 2-year yield in this case, so the short-term rates, that's what the Fed eventually always ends up targeting because the market always knows first, right? Okay, so after this tiny little tangent in the beginning, let's move on to the data relevant for this week. So we got PPI month over month, which just tanked once again. So again, not inflationary at the very least, and even the year over year, as you can see, it stayed relatively flat at the end of the day, and it looks like again it rebounded a little bit, and then it just you know reversing back to the lows once again. Although, contrary to expectations, the CPI print, especially the month of the month, it was a bit, I'm not going to say massively, but a bit hotter than expected, right? It was expected at what? Not 0.3, it came in at 0.4, kind of in line with a lot of Wall Street analysts. So, just 10 basis points above consensus at the end of the day. Still, you're not looking at a massive trend to the upside, and it's even clearer if you just check the year-over-year rate. We are kind of around 3% now, and we've been at this level since July, June 2023. We were a bit above it before, then a bit below it, and then we just gravitated back toward 3%, which again, it could just fuel the talks about 3% being the new normal, and at the end of the day, the Fed will give in and admit that, the 2% target rate, it's no longer something they care about, and they are okay, they are fine with having it at 3%, which again, it's something that we already hinted at. I guess it was last week when we said that Powell was talking about this long-term average inflation rate, and therefore, well, we tried whatever we could after '08, and for a good decade, we were unable to hit and maintain regularly at the 2% target. We were always below. So, if for a few years we are a bit above it, longer term, it's going to average around 2%, more or less. Or at least that's you know, the narrative, the logic that he would like to sell you out. Whether you believe it or not, it's not up to me. I just think, to me, it's just a bit funny when at the end of it, it might take months, it might take years, but it looks to me like at the end of the day, is always the central power, the institution, is always the policy maker, which has to bend the knee to what the market is actually doing. But again, it's another one of those debates. I'm not saying the Fed or any other type of institution or the government itself. I'm not saying they could not impact the economy. Actually, I think they are impacting the economy a lot, not in a positive way. They are creating distortions, right? But it's just that over a longer period of time, I still think the market is always right. Okay, no matter what they try to do. Moving along, we had a huge jump in the initial jobless claims, which printed what 263,000. So I've been talking about this threshold. Uh, Wait, did I say it right? Threshold, all right, at 260,000. So it looks like we hit it once again, and I think still this is the level where if I start to see these data set staying at these levels and hovering around these levels and potentially, using it as some sort of uh, what do you call a new level, right? From from which it can just keep on jumping higher than where that probably you have hit the tipping point of the recession. Launchpad, that's the word I was missing right a few seconds ago. So again, we'll see. I mean, it could just be like in the past. We've seen this level being hit and then it was quickly faded, right? So it's not all doom and gloom just because we hit it once again. So to me, it's always about the trend, or at least, if you want to make or run a parallel in between these and what could be a price chart, it's all a matter of acceptance above the level in this case. So if it is just a tap into it and then it's a nothing burger and it comes back down and it stays down, yeah, well then I guess it was just a blip. But if you see it starting to be consistently around the level and starting to grinding to the upside, you'll know that something is not all right for real this time around. I mean, how long would you take as the time for judging it? Well, this data point is released every week, so I would say maybe at the very least uh, a month, so 4 weeks, 2 months to make sure. But yeah, just to highlight the fact that one data point alone, it's not conclusive to me, right? Then we had, of course, the continuing jobless claims, which again are particularly high. So it just ties in with what we are looking at in the rest of the labor market data. Finally, we got the Michigan Consumer Sentiment Index or survey, should I say? Which again, it came in below expectations. It was expected at what 58, came in at 55, and as you can see, the trend is down. So again, we go full circle with what we were looking at in the beginning in the slides when we think about the labor market deteriorating, therefore sentiment is decreasing because people are looking around and they see that although they have been told over the last 2 years that the economy was red hot, they look around and they say, well, maybe, but I mean, if you just step down from your ivory tower and you just start to walk down the streets, it's a little bit different down here, right? So yeah, with all of that, we've seen break evens keep on coming down, right? And if we look at the unconventional measurements for inflation, you see true PCE around 2.6 and CPI around 2.15, which, it's still around target. Sure, it's not as high as 2.9, the official CPI, but there's always this delta in between the two. So again, I keep on saying if it was true while we were having a lot of inflation that the official CPI was underestimating the real inflation, can it be true that now the official CPI could overestimate the real rate of inflation? Because again, I always have this inner debate in myself, like if this data was correct before, should it be correct now as well? So otherwise you're just cherry picking it, right? Um, and again, as for the rest, the Fed funds futures are now pricing in at 93% chance we are going to have a 25 basis points cut. next week. These, the chances for a 50 basis points, they jumped up to 12% when we got PPI. But I guess, the tiny, slightly hotter than expected CPI print, they, it just sent that lower to 6%. I don't know, quite honestly. I think, it's always the same thing. Historically, as far as I could have seen, Powell had this tendency of not disappointing the market or spuking the market. The decision of cutting rates was telegraphed well in advance, starting from Jackson Hole. So, you know, I don't, I wouldn't have any other reason to believe that this time is going to be different. So maybe a 25 basis points cut, unless, the only thing for me would be, I've always had in my cards the 50 basis points eventuality, right? I'm not saying I'm completely discarding it. I would say it depends on how much their balance of risk has shifted. Like, even if you get back to the jobless claims, if they really start to think that, as they said, even if we have a little bit of a spiky spike in inflation, tiny little spike in inflation due to tariffs and all the rest, if they still think, as they declared, that it's going to be a one off, but on the other side, the labor market, it's really showing cracks now. So they could tilt from, yeah, I mean, inflation could be a one-off, but what I see on the other side is that the labor market might not be a one-off. So if I don't want to be behind the curve, I better shift my attention to the labor market instead of this one-off event on the inflation side. And so could it be beneficial to me cutting 50 because I skipped the July cut, right? So that's the only thing I would keep in the cards for a 50 basis points cut. But I would have put a lot more odds on it if we had a cooler than expected CPI print. Wasn't like that, so I guess we're still kind of in limbo with this one. At least, the only one thing we do know is that they are gonna cut. All right. So that would be it for the economic calendar and the fundamental standpoints. So let's have a look at the charts instead, shall we? Let's start out as usual with currencies, and what we see is that the dollar is kind of weakening, as we've seen, this week in particular, right? I just went down at the end of last week, tried to bounce this week, but it was faded for now. So, I mean, at the end of the day, it's still just grinding in this range. It's not really tanking. And as you can see for the rest of the currencies, at least in the majors, what you see is that specularly, the euro, it's grinding to the upside a little bit. Not a lot of acceleration so far. And same for the pound. Uh, the yen, it's basically flat, and the behavior in all the others, it's kind of the same. The the only one which is strange is the dollar Canadian, which it's grinding to the downside. So while the DXY is going down, the dollar Canadian is grinding down. But at, at the end of the day, the Canadian economy, it's not performing that well. So that could be it, maybe, right? I guess the only anomaly, if you want to call it that, is that while the DXY is going down, the Chinese yuan, although again the DXY it's majorly weighted against the euro and the yen, so it's not a direct reflection against all other fiat currencies, but just as a proxy, right? Just because I don't want to pull up the charts of the trade weighted index or the US dollar versus emerging markets index and all the rest. But let's just use the DXY as a proxy. So if it's weakening or grinding lower, what you expect is the Chinese yuan to grind higher. Same for the South African rand, and of course the Brazilian real. The Aussie dollar had a little bit of a pump these last 2 weeks. So again, kind of like the other majors at this point. So the only two anomalies, again, is the Russian ruble coming down, I mean, could it be that all the talks about sanctions and whatnot? I mean, I do believe sanctions they don't really work on Russia. I mean, we've seen it. As a European, I can tell you we've seen it, right? They end up hurting ourselves more than them, I think. But it could also be that one of their minister actually came out saying that Russia is really facing a recession risk right now. So it could be that those statements actually contributed to weaken the ruble a little bit, right? And again, the the Indian rupee, although again the dollar looks like it's weakening, well, so is the Indian rupee. So you know there is a lot of geopolitical component in this one. I was reading that the negotiations should come back online in between India and the US for a trade deal, but still the situation overall it's still a little bit on the you know on the difficult side, right? So we'll see how it's going to develop itself. But for now, we're still looking at the same trends overall, right? Now let's have a look at oil. Oil basically went nowhere this week at the end of it. It started on Monday in here, it bounced, and then Thursday was just sent lower again. Tried to rally on Friday, but again, looks like a rejection so far. Now, again, still hovering around these base right here. Although, one bounce to a bit of a extended bounce, back into it again, tiny bounce, back into it. I don't know. We'll see. I would need a bit of confirmation, but I remember last week the assessment was, yeah, this base again, so maybe another tiny bounce. If you see that faded, let's get ready to try to tackle lower prices. Will it be? Again, I guess just overall the trend is the trend, and if you, I know you shouldn't, but ideally, if you remove this massive spike to the upside, which was due to that was the period where the US bombed the Iranian nuclear site. So if you just imagine it as it never happened, the fundamentals were lower for oil prices. So maybe now that the geopolitical premium evaporated, we see global fundamentals getting back at play. Um, you know, it's one of those things. At the end of the day, I think that over the longer run, right, you will see oil going up. I'm not saying it's gonna get back to 120 or something like it, but I think it will keep on staying relatively stable. That now, why am I saying that? It's because do you know when you look into the energy markets or you look into the energy consumptions overall globally, and you see that there are a few, but there is that infamous chart where you see that every time we as humankind we get access to a new type of energy source, it's not that the consumption completely shift to the new energy source and we stop consuming the old one, right? We add the new one on top of the previous one, but energy consumption overall keeps on going higher and higher. So again, what I'm saying is that we have talked about the arbitrage in between oil and nat gas. Now, for the first time in ages, even in the West, we are talking about giving nuclear a second chance, or maybe it's just the only chance we got if we want to build up these AI infrastructure, given the power consumption that we would need to face. So just because we are going to invest a lot in gas and nuclear, well, guess what? That doesn't mean that we will stop consuming oil, in my view. So again, at a point, I think oil will have its moment to shine again, just because of historical dynamics. It's just that for now, in the short, medium term, right? Fundamentals, especially when you look at the global economy, are not particularly good for oil, which is why I think it's going down. Or even if it's not technically going down yet. It's just staying in this range for now. It's drifting to the downside a little bit, but it's not a complete crash like we have seen, for example, in here, or in here, or in here, or in here, right? It's just slowly moving down. It's just reflecting fundamentals in my view. Still, what goes into the price of oil, it could be, distorted or impacted a lot by geopolitical events. So, God forbid you see something coming out of the Middle East. As for the conflict getting wider, yeah, at that point you might expect a little bit of a bump into oil prices, especially because if you check the positioning, um, there are not a lot of bets on the upside for oil. So not a lot of bulls. It doesn't necessarily mean there are a lot of shorts on it, but yeah, it's just, it's a market which is out of favor for now. So tiny little catalyst, and yeah, people could just swamp into it back again. On that note, here's a tiny curiosity. When you look at these, what you see is basically the price of oil compared to the XLE, so the energy sector, as for the stock market. Now, what you see is that there is a huge divergence in this one. So, energy stocks, energy producers, I would assume, they went up particularly, you know, good enough in this period over the last 2 years, 3 years almost, while the price of oil was kind of tamed, right? Now, if you check, you don't have this type of correlation, or, well, negative correlation historically. They tend to move together. So I think, again, even in this one, there might be an opportunity on each one of the sides, because when these breaking correlation closes in, uh, it could happen just in two ways, right? Either the XLE comes down to reflect the price of oil, or what you're going to have is oil, you know, coming higher to get back in line with the XLE. I don't have a definitive opinion on this one. I mean, at first sight, I would assume that it should be, you know, the XLE, which should catch up with the oil prices. But just because I'm kind of trying to eyeballing that, and I'm seeing like in here, what you see is that oil goes up first, and then the energy sector follows. Oil peaks out and comes back down, and a bit later the energy sector follows. Same here, oil bottoms out, start to come back up, and the energy sector is following, sorry. So, you know, uh, could be that at the end of the day, it's just a warning sign if you are in the energy sector. As for the stock market, um, I think, the reason of the divergence or distortion, it could be that for whatever reason, there is so much liquidity around in the world yet that everything is catching a bid, whether you believe it or not. Look around, everything is basically at all-time highs or moving to the upside, really. Like stocks, gold, Bitcoin, everything is up. Even bonds had a good week this week, right? So could be just a liquidity type of dynamic, as is often the case, right? But let's move on to gold. Okay, gold kept on rallying this week. We've seen like Monday. I mean, it started to the pace, the rate of change decreased a bit, but still it's grinding to the upside. Now, I got I got a few questions. How did I come up with the target? I was talking about the 3,750 or 3,800 level. Well, basically, I'm not a Fibonacci guy, of course, but it was just an extension. If you take the previous peak and the previous low, which define this monthly consolidation in here, you got an extension right at this level. So that was basically, my logic for it. Um, the disclaimer that I'm not a Fibonacci guy just implies that maybe this is not the correct way to draw the fee, but then the extension. But on top of it, I think 3,800. It's also a good, a relevant level. Plus, if you just go back in time and you measure the percentage of extensions in price excursion before a decent pullback or a consolidation, we are reaching out into extremes. And if you go, on a higher time frame, what you may look at is that we are overbought on many different levels. So, could be that after we tap into this psychological level, we might have a bit of a pullback. I'm not talking reversal. Again, I'm just saying pullback. Fundamentals for gold are still the same in my view. So for now, no need to worry about it. It's just, you take a bit of profit, you trim your position, and then you wait to have the chance to add back in if you have a decent pullback, right? Could be the retest of the previous range high, or you just draw a new feed from here to here. You look at the sub 50% levels, and you try to find something which aligns with structure in order to place a limit order there and put in a bid in this market. Again, nothing new for me with gold. It's just running to the upside, so up until the point it doesn't stop. Uh, if there is no local top put in, it's pointless to call for the top up until the point you don't see it, in my view. And I guess the best way of managing risk could just be, trimming your positions, because if you have a very good position, right? Let's say you have accumulated in this range. Well, let's say you sell the position entirely, and then instead of a very good and pronounced pullback, what if you end up having just a shallow pullback and then it keeps on going higher and you sold all your position? You're gonna give out on a few more gains, while instead just do it in tranches, right? You sell a bit here. If it comes back a bit lower, you sell a bit more, and you keep on selling if it keeps on going down. And when you see it bottoming out, you add back in, right? So you always maintain a bit of exposure to it if your fundamental thesis is always the same. But at the same time, you're banking in profits as you go, which is always good. Not only financially, but also, I guess, psychologically. It would help you a lot managing the position. So, as for gold, let's have a look at this one, for instance. If you check the CTA position in gold, even in here, it looks like we have a little bit of divergence, right? So the CTA positioning in green against the price of gold in white, while we broke out of this consolidation, the exposure of CTAs actually declined. So again, could this be that the trend or the up move, the momentum, it's getting to an end, and therefore we're gonna lose momentum? What's gonna happen after that? I don't know. Probably at the very least a consolidation, if not a pullback. It's just this is just positioning, right? If you want to look at the bright side into it and keep on being bullish gold, you could also say, well, they distributed a lot while price was going higher. So if now price comes back lower, they got space to add back in. So it depends how you want to read it. There are, I guess, two ways two different interpretations in this one, in my view. But on the other side, again, if you want to be really bullish gold, here's another interesting divergence. What you see is that, although the spot prices for gold actually came up a lot, what you see is that gold ETFs, they didn't really catch a lot of bid. What does it mean? It means that basically the retailers, they are not a lot exposed to gold. Why is this, you might ask? I don't know. First thing coming to mind is that the stock market, it's showing such a strength that probably the retailer, it prefers to keep on buying the dip in the stock market, and therefore it's not really interested in gold yet. And so, again, it's no guarantee of anything, right? It's just for the sake of argumentation. But the narrative for bulls would be, look, if the price of gold went up so much and we don't even have retail investors piling in yet, imagine how much he could go, how farther he could go when you have retailers coming in. Okay, maybe. I mean, I'd say I wouldn't dispute against it. I might be in agreement with it, but I would also like to look at the other side of it, which is okay. But the retailers, in my view, being interested into gold, perceived as a safe haven, that would happen only if all of a sudden you have some sort of a trouble in the stock market where they are massively exposed. So they could rotate from stocks into gold, right? Providing a bid for gold in that instance. But the problem I see is that, as I hinted at in the beginning, everything is up. Stocks are up, cryptos are up, gold is up. So let's say my risk assessment, it's a bit different because I'm thinking if we have something sending the market lower, risk on assets lower overall, gold can already price that in, or a lot of people already bought into gold. Who's gonna tell me that the potential bid these retailers could place in the market, it's gonna be enough to offset all the people which would liquidate the gold just because they need maybe to cover the losses elsewhere, right? That could be a counter argument to it. Although, at the same time, I think that the majority of the price appreciation we've seen in gold is the result of geopolitical events and global phenomena going around with central banks bidding gold because gold has no counterparty risk. So from the central bank standpoint, if gold tanks like 10%, the central bank which bought it, it's not gonna dump it just because the price went down a little bit. So again, maybe it could be at the end of the day a huge nothing burger, but I'm just trying to bring in the things I've seen throughout the week I found interesting, and I kind of meditate a lot. Well, a lot, a little bit, let's say, onto them. So just to give you a little bit of a framework on how to think about things, right? It's not only black and white, and just because you read it on Bloomberg, it doesn't make it right or it doesn't make it true more than any other source, right? Just always try to be critical on things and try to picture all the different scenarios and then manage your risk accordingly, I guess. Enough with gold. Let's have a look at Bitcoin, which had a really fantastic week this week, and it looks like it's keeping on parting even over the weekend. So a bit of a surprise, yeah, maybe. I mean, it was looking kind of weak, I guess, but you know, uh, it just things could go one way or the other. Actually, they could go three ways. It could go down, up, or sideways. But there were two scenarios even in this one. So although it was looking weak after this rejection, right? And although last week it closed, after regular week it closed, I guess here, right? And then we got Saturday, Sunday, it kind of bounced a bit, and then on Monday, Tuesday, especially Wednesday, it just broke out to the upside instead of rolling over and getting back into the lows, which again I deemed that I said that I would have deemed the lows as very weak now if retested and reapproached it once again. Didn't have that. And the other scenario, so the squiggly lines that I drew were kind of, if you remember that, um, they were kind of respected. Like, look, you see this level right here? We came above it, we tested it, tapped into the other level to the upside. It was rejected. as you can see. We tapped back again, right in the level we just broken out of, and we kept on going higher and higher. So, I mean, I guess next level would be this one at this point, if we keep on going higher. 117,000, give or take. Although, these tiny little apex right here could provide maybe an intraday rejection. Although it looks like we already had it. It was right here. Yeah, it lines up good enough for me. So again, drawing back the inefficient move into the apex on the hourly time frame. Yeah, I think we should test into this level if upside is confirmed in the coming days, right? Could be tomorrow, could be Monday, could be Tuesday. I don't know. What is important to look at is that we at least we broke these two highs right here. Does it mean we're gonna shoot back to the highs in no time? I don't know, and I would say maybe not, because I think the crypto market, or at least Bitcoin, actually changed a little bit. You're not looking at massive runs with go, with without interruptions for weeks or months, but it got way more efficient now. So could we go to the highs? Yeah, maybe. I just think it's not going to be a straight line like it could have been in here, right? So I think, if you try to isolate these two segments right here, I'm going to try my best. Look at this one. You got these larger consolidation right here, right? And then you go on a different scale, both in time and, ranges. But you got this one right here, right? Look at this one. So what I think is that when you got contractions like these, now the breakout off of the contraction could be impulsive, right? Like in here and in here. But overall, I would expect at a point in time these leg right here to be rebalanced or drawn back in before further upside. Now again, it's hard to tell right now because in order to try to start and think how much of a pullback would you expect? Well, it depends from where it starts. If it starts from here, it's very likely we test back into it. If we keep on rallying a bit more, then again, it could just be a much shallower type of retracement. So context is always extremely important. But it's just, it's that fractal behavior. This consolidation right here, it took what? From May up to July to be resolved, and the resolution move off of it was particularly impulsive. Same with this one. The consolidation started in August, at the end of August, was resolved in the beginning of September. And as you can see, the resolution off of it, it's particularly impulsive. So this is why I say, yeah, it can have those impulsive moves, but at the same time, I think in time, as we've seen here, they are going to be rebalanced out. Just because I think the market is different right now. It's way more efficient and it's way more structured. And again, I think it's just testimony of the different participants that we got in right now, right? So that would be it for Bitcoin. I think as for Bitcoin, as for the news, did we have anything? Well, I've seen that MicroStrategy, yeah, that was the thing. MicroStrategy was rejected from the S&P admission committee, which means that it's not going to be incorporated into the larger index. Now, in and of itself, is this a massive problem? I don't know. Like the only thing you could look at is that we have a little bit of a divergence now in between Bitcoin movements and MicroStrategy. I think it could be maybe if you want to see a warning sign into it, it could be that if you look at the amount of companies which started to or try to be uh, crypto treasuries companies, so to speak. Let's say, let's rephrase that. Let's say they started to add cryptos in their treasuries holdings, right? So as a reserve asset, let's put it this way, that amount actually increased over the last few years, mainly over the last 1 year and a half to 2 years. So everyone tried to copy the MicroStrategy model, or no pun, but strategy, right? So maybe it could be that although MicroStrategy it fits the criteria to be allowed into the S&P 500, the fact that they rejected it, it could be that maybe they don't want to have such a high leverage play into the index because of the potential repercussions it could have if, God forbid, all this leverage could come unwound, right? So that would be the only one thing I could read into it. As for the rest, I think uh, do I think MicroStrategy over the long period of time will impact the price of Bitcoin? I mean, yeah, if they all of a sudden they go bankrupt and they have to liquidate all the Bitcoins, yeah, absolutely. Um, but over the short term, the fact that they have been rejected by the S&P admission committee, uh, I don't, I don't think so. I mean, it could impact and impacted the price of the stock, but I don't think it's going to have negative repercussions on the price of Bitcoin at the time being. Right now, finally, let's try to move into yields, which again, they collapsed, so to speak, last week on the back of bad labor market data. They stayed relatively weak this week. They didn't really go anywhere. They keep on drifting to the downside, or being relatively stable at these lower levels. Maybe the 2 years actually rebounded a bit more than the rest, but I'm not really seeing a change in behavior in these ones. Um, I guess there's always the same talks about, of course, as the DXY it's showing a bit of weakness. There's always the same type of narrative going around, as in, the world is rejecting the US dollar, the dollar is doomed, and no one is going to beat our treasuries, we are not going to be able to refinance and all the rest. Although, if you go beyond the narrative a little bit, you see that when you look at the net buying and selling of long-term domestic securities, as for the tick data, what you see is that last few months, well, there was a huge amount of demand for treasuries. And even when you saw in the past these flows actually being negative, I mean, look at the timing of it, right? Let's get back a few years. August '07, right? November '08, well, actually October, November '08. All this period, do you remember what we got in between 2014 2015 in Europe, right? Now, why might say a debt crisis in Europe should lead to a lot of selling on treasuries? Well, because if my debt as a European nation is going fucked, you know, the quality of my debt against, let's say, US dollar debt, so the spread, the differential, it's going to increase. And the problem is that I, as a foreign nation, I'm not only holding debt denominated in my local currency, I also have dollar denominated in US dollars because maybe I contracted it in the euro dollar system. So when I have a crisis in my local denominated debt, what is going to happen is that in order to fill that gap, right, I'm going to have to do what? If I got one side of my balance sheet being fucked, I need to sell another part of it to just fill the hole. What could I sell? What is that I have in large quantity and it's performing particularly well relative to my own shit? Oh, wow, I got treasuries. That's why I called them reserve assets, because I use them for the rainy days so that I can sell them in order to get the liquidity I need to face my current obligations. And which is why I guess you've seen a lot of selling in US treasuries throughout that period. Now, of course, there have been other different spikes, even in 2018, 19. Was it the taper tantrum? What was it? Maybe was that. I don't really remember on the top of my head. But then, of course, you had what? March 2020, massive liquidity event, global economy being halted. And so what's happened? What's going to happen? What do you think is going to happen? Yeah, it's the same thing. We rely on debt for many different countries. It's easier to be funded in the US dollar denomination because it's much larger, it's much more liquid. It gives you a lot of easy access to credit. What happens if all of a sudden the economy is shut down and all of the inflows of US dollars, which were coming off of global trades, those are shut down too. So you don't have any other type of revenue able to service the debt and to pay the interest on the debt that you contracted in a USD denomination. What are you going to do? You're going to sell your reserves. Again, same as the European debt crisis, right? And of course, April 2025, still probably kind of the same. I mean, if you think about tariffs, obviously they are going to impair global trades. So therefore, on the expectation that global trades would have been impaired, you might have seen a bit of stress in some emerging markets and therefore a little bit of liquidation of treasuries. But other than that, you see that there is still a bid for treasuries, whether you believe it or not. And if you check the last 10 years treasury auction, which went off, I guess, I think it was on the 10th or 11th. It was either Thursday or Friday. I don't remember the actual day, but that was very good. I mean, the bid to cover ratio, it wasn't fantastic, but if you just check how much the amount that was, that the dealers were able to put their hands off, it was very low. Now you might say that is a problem for the dealers. Not necessarily, but it just tells you that there was a lot of, the so-called indirect bidders, which is basically the rest of the financial system. Because usually the dealers would bid, right? They have the legal obligation of bidding at these auctions, and then they place the treasuries they just bought at the auction on the secondary market. But if you got indirect bidders, that means that it's not the dealers which are taking on the majority of the auction and then trying to place it in the secondary market. There are a few people out there, which of course always using a third party, which could be again a dealer bank, but they are buying up the treasuries at the auction and they're keeping them for themselves. So the dealer it's buying the treasuries, but it's not buying them for himself. It's buying them on for the on the order of some big client. So it was a good auction at the end of the day. And so again, this narrative of treasuries being rejected, I'm sorry, it doesn't hold any water in my view. At least the way I see it. All right. And look, if you go on a year-to-date type of a chart, I mean, yields across the board are just lower compared to where they started on January 2025. So again, if yields are lower, right, there is an inverse relationship. So it just means that for some strange reason, treasuries must be up compared to the beginning of the year. Now, if you zoom out, it's also true that they are still in a very precarious situation. No shit. But I keep on thinking that, the things which are out of favor, the things that nobody wants, at a point, you're going to see a massive bid, right? It depends on the economy, of course, right? But yeah, that was my thesis. It's been my thesis for 2 years long now, and it's still there. I didn't change my tone on it. All right. So okay, that would be it. Now let's move on to stocks, and as usual, before that, I'm just gonna take a brief pause. Right. Moving into stocks, let's have a look at the heat map for the week. What do we see? You know, it's not bad actually. If you look at the market, overall indices went up. So I mean, I guess The start of the week was Oracle. If I can find it in here, there you go. So again, many different people are talking about the AI bubble or the AI trade being exhausted. Yeah, I mean, yeah, Nvidia was pulling back, and then we got this announcement from Oracle, which, uh, ironically, they missed earnings, but the guidance, it was really stellar. Because what happened is that they said, yeah, we didn't deliver on the earnings side, on the actual earnings side, but we have just signed uh, a very important contract which will bring XYZ amount of revenues over the next few months. And we have many other different contracts on of the same side in monetary terms in the pipeline to be signed. Therefore, although we miss revenues this time around, let's wait up because in the future, with these contracts signed, the amount of inflows of revenues of money that it's going to hit us, it's going to be massive, right? So of course, people jump onto it. I think at a point the stock was up maybe 35%, something like it. And of course, on the back of it, the rest of the AI environment just followed along, like Google, Nvidia, Meta, Microsoft, and all the rest. Which again, I think that was the main catalyst for this week. And if you check the charts, what you see, it's finally the Nasdaq made new all-time highs, and it got back in line with the S&P. Um, on the other side, what we've seen is that although they are still trending to the upside, the Dow and the Russell ended up the week on a little bit of a pullback. Now I guess it's nothing major yet. But it's kind of the same as last week. At the end of the day, they basically closed almost where they started. Like, at least this is true for the Russell. The Dow actually it closed a bit higher because it closed right here previous Friday, and this time around it closed like right here, so a bit higher than the previous close. But yeah, still, no, from a structural standpoint, no major problems. Fundamentally, I still think these are bets which are, a bit on the risky side overall, even among risk on assets. But, up until it goes, it just goes. Let's have a look at the price action for the week, right? Let's get back to previous Friday. We ended up with the dump on NFP news. Then, on Monday, we started to grind to the upside. And, the week was kind of like that, basically up until Thursday. It was up, down, both for the S&P and the Nasdaq. On, Wednesday, again, up and down. And up until the point we got to Thursday with CPI, which again, although it came in a bit hotter than expected, didn't move the needle a lot. And the S&P just, I mean, that's a crazy pump in the S&P. You're used to seeing these type of behavior in the Nasdaq. The Dow, even the Dow was kind of crazy on Thursday. And of course, now we have this very weak leg which needed to be rebalanced out. Could it be the same for the S&P since, it was a very good move to the upside? Um, I think what we've seen on Friday, we hit what 6,600. So, round number, psychological level. It looks to me like a little bit of exhaustion, at least for the S&P alone, right? The Nasdaq, it's a completely different picture at this current moment in time. So wouldn't be surprising to me if we see a pullback overall, especially on Monday, maybe Tuesday, getting back a bit lower to rebalance this tiny leg up. Um, and then, we'll reassess from there. Look, this is just intraday type of talking, right? Overall, again, you check the daily, you don't really see any type of danger. If not, yeah, basically, yeah, the S&P hitting a psychological level. But as for the rest, this is all cool for now. From a price action standpoint, maybe, at the end of the day, if you look at the week in its entirety, it was an up only week, if you wish, and maybe we're due for a tiny bit of a pullback. Like if you look at the weekly time frame, for instance, you see it's a week like that in the S&P. It's been a lot since we didn't have something like it. We need to get back to the beginning of August. So yeah, I mean it doesn't really happen so often, right? And then what usually comes after it, it's a little bit of a choppiness. Although that was August, so summer trading, not really conclusive. I would say a tiny pullback wouldn't be unusual from these levels. And overall, I think we will keep on pushing up until the point again we don't have a catalyst for a much pronounced type of a pullback. Two things. We see that again we are still above all the major moving averages. Now we have deviated a little bit even compared to the 21 exponential in yellow. If you look at recent behavior, every time we have been, particularly deviated away from it, we tended to get back into it in here or in here, right? So again, this is why I'm saying maybe a pullback. It's not that crazy idea. Bear in mind, it's an exponential average, so it's gonna catch up with price action relatively quickly. So don't expect a huge pullback even in the case we have one. Um, I think there was another thing I wanted to say. Oh yeah, we're gonna talk about the seasonality. September again, it's the weakest month historically as for the S&P returns or the market in general. We defeated the statistics, the statistics for August, so there is nothing preventing us to break the stats even for September. But look, starting next week, we are gonna have we're gonna enter the corporate share buybacks blackout window, right? So again, we are gonna have a huge buyer removed from the market. So that could be a thing. Um, I mean, is it going to be a massive problem? Not necessarily, but just if you account that the majority of the upside in indices is due to corporate share buybacks, it's at the very least it's something to be considered, right? So it doesn't necessarily mean that we're going to have that pullback, right? But maybe a bit more of an erratic type of price action. So still, I would expect again the overall market might keep on grinding to the upside, but intraday you could still look at a two tape side of a two tape type of a market, right? So be aware of that. Intraday volatility will be still present in my view, but overall, I don't see any particular risk for this market right now. Also, bear in mind, maybe not next week, but getting into the end of the month, we might see a bit of the famous window dressing phenomenon. So if you check the positioning, what we see is that hedge funds, money manager, they are lagging a little bit behind the market right now. So it could be that they are gonna catch up just to make sure that when they present the quarterly statements to the clients, they could show that they are actually allocated in the stocks which perform the best throughout the last period, which is why it's called window dressing, which could provide a little bit of a bid for the markets and therefore offsetting the corporate share buybacks going into a blackout window. It's all speculation. Of course, we don't know for sure how these two dynamics are going to interplay in between each other. I'm just saying, uh, I I would expect kind of the same that we've seen so far, right? that would be it. Now, look, let's have a look at the positioning even for these markets. So it looks like, overall speculators are actually betting on the short side. Uh, I don't know. Is it just a problem of edging because we are getting into FOMC? Uh, don't really know what to make of it, to be quite honest. At the end of the day, overall, the positioning it's still in the 90 percentile when you look at CTAs. So, you know, it's not really extreme, like it's not really touching 100%, but we are in the higher quadrant, so to speak. So I would exercise caution from that point of view. I think, at the end of the day, what's going to move markets, especially when it comes down to stocks, it's as usual, fundamentally, it's uh, earnings estimates. I know that people might say, yeah, the market it's a discounting mechanism, or at least it should be, but it's completely detached from reality in recent times. That is true, but still, as for the market itself, the fact that people are willing to pay a premium because the revenues earnings for these companies are projected to be massive in the future, it's still a factor at play. So I don't think we are going to see decisive weakness in these markets up until the point you don't see those future earnings growth estimates being revised lower. Again, going full circle, why do you look at the labor market data? Because where do corporate earnings come from? Consumption. What do you need in order to see consumption? Well, you need a good enough labor market. People being employed, people getting a wage, right? So again, it's all tied up together. And the same way as the virtuous cycle works to the upside, so it works to the downside. Again, it's just something that you should keep on monitoring day by day, especially, sure, if you're day trading it, that's not going to matter to you. But if you have much medium to long term position, sure, you want to be aware of it, right? At least to understand what type of a regime we are, right? And when it comes down to those earnings, ah, there is a little bit of a concentration, whereas the majority of earnings growth just came from financials and, mega cap and big tech. All the rest, especially if you look at cyclicals, energy, materials, they really didn't add a lot as for earnings. So I think again, sometimes you find similarities in between the market. When you look at these or when you look at the breadth of the market, there are parallels you can run in between these and the so-called K-shaped economy in the US, right? So, if you own the stocks which are growing a lot, the big cap or the Max 7, yeah, you're making a lot of money. You are happy. And especially if you own stocks in general, right? If you don't, and if you just rely on your paycheck, well, again, is the economy so good? And therefore, when you look at the market, it's really the market, the discounting mechanism that you would think it is. And why it's not discounting the fact that me, my family, my neighborhood, right? We are all in a lot of financial stress right now, and yet the market keeps on going higher and higher. Yeah, I know. That's a tragedy of our lifetime to some degree. But what you're gonna do? At least be aware of the differences, right? All right. So there is nothing else I would like to talk about for this week. So I think I'm gonna cut the video off. Now, just one thing. Let's have a look at the economic calendar for next week. We are gonna have the Empire State Manufacturing Index on Monday. Then, of course, on Tuesday we have retail sales, industrial production. What else? I mean, if you're interested in the balance of trade, we got exports, imports, and all the rest. But all the focus will be on Wednesday when we gonna have FOMC meeting, right? And therefore interest rates decision announcements. I keep on thinking it was vastly telegraphed, but again, part of me it's still keeping that door open for the 50 basis points. Although, as I said, I would have put more odds on it if we had a cooler than expected CPI, but yet I still think it's the possibility at the very least it's there. Maybe, I don't know. Uh, the market is putting I mean, it's just that I don't think it's 6%. The possibility of a 50 basis points cut. I'm not saying it's 80% or 90%, but I mean 20, right? A bit more than what the market is pricing in at the very least. So yeah, let's leave it at that. I give it 1 in 5 chances that we are gonna have a 50 basis points cut, right? And we are gonna end up the week with the usual unemployment, sorry, jobless claims on Thursday, and then Friday. Well, nothing on Friday, it looks like. So yeah, again, next week, you know where the focus is, and you know what the market it's waiting for. So here's your big catalyst for next week. With that being said, have a nice weekend. I'm surely gonna have. There is a festival in town, and I'm not gonna miss it. So probably tonight I'm gonna be massively drunk. But yeah, just I'm not saying you should do the same as I will do, but let's have fun, right? We'll talk again next week. Up until that point, be nice and be cool. Knees out. Ciao.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.